During the COVID era, the average 30-year fixed mortgage rate was around 2.5% to 3.1%. Today, that same mortgage rate is closer to 6.5%. That may not sound like a huge difference at first, but financially, it changes everything. Borrowing money has become dramatically more expensive, and it's reshaping the entire housing market. Over the past few years, inflation has remained elevated, hovering around 3.3%, with some projections suggesting it could move closer to 4% rather than falling back to the Federal Reserve's long-term target of 2%. As inflation stays high, interest rates tend to remain high as well because the Federal Reserve uses higher rates to slow spending and cool the economy. Now look at what this means in real numbers. A $500,000 mortgage at a 6.5% interest rate would cost roughly $3,500 per month in principal and interest alone on a 30-year loan. On a 15-year mortgage, the payment jumps to around $4,400 per month. Compare that to the COVID-era environment where rates around 3% could bring the monthly payment down closer to roughly $1,700 to $2,000 for the same loan amount. That difference is massive, and this is where affordability becomes a serious issue. The average income in the United States is around $65,000 per year. After taxes, healthcare, Social Security, and other deductions, many households may only take home around $4,000 to $4,400 per month. When a mortgage alone could consume most of that income, it becomes clear why so many Americans are struggling to afford homes today. What makes today's housing market even more unusual is that these higher interest rates affect buyers and sellers very differently. For many home buyers, this changes the entire calculation. Instead of asking, "Can I afford the home price?" buyers are now asking, "Can I afford the monthly payment?" And in many cases, the answer is becoming much more difficult. Higher mortgage payments mean buyers may need to settle for smaller homes, move farther away from expensive cities, increase their down payment, or delay buying altogether. This is especially difficult for first-time buyers. Many younger households are already dealing with high rent, student loans, rising insurance costs, and inflation affecting everyday expenses. Saving for a down payment while also qualifying for a much more expensive monthly mortgage payment has become a major obstacle. As a result, many buyers feel stuck watching homeownership move further out of reach. But interestingly, sellers are facing a different kind of problem, something economists and housing analysts now call the lock-in effect. During the COVID years, millions of homeowners locked in historically low mortgage rates around 2.5% to 3%. Those rates were some of the lowest in modern history. Today, if those same homeowners decide to sell and buy another home, they may have to give up their low mortgage and replace it with a new loan closer to 6.5% or higher. That creates a huge financial disincentive to move. As a result, many homeowners are choosing not to sell at all. They are staying in their current homes longer than expected because financially, keeping their existing low-rate mortgage makes far more sense than taking on a new expensive loan. This is the lock-in effect, and it's one of the biggest reasons why housing inventory remains tight today. Normally, when housing demand slows down, more supply enters the market and prices fall more aggressively. But today's market is behaving differently because sellers are holding on to their homes. Fewer people are listing properties, which limits available inventory. So even though buyers are struggling with affordability, the market is not seeing a massive flood of homes for sale like it did during the 2008 financial crisis. This creates a strange and unusual housing environment. Demand is weaker because higher interest rates make homes harder to afford, but supply is also restricted because homeowners are financially locked into their low mortgage rates. The result is a market where activity slows down, homes stay on the market longer, and price growth cools. But in many areas, prices still remain relatively elevated because supply is limited. For buyers, this means the market may feel frustrating. While competition has cooled compared to the pandemic frenzy, affordability remains difficult because mortgage payments are still extremely high. Buyers may have more negotiating power than before, but many still struggle with the monthly cost of ownership. For sellers, the market also requires adjusting expectations. Homes are no longer selling instantly in every market, and buyers have become much more cautious. Sellers who overprice their homes may see fewer offers or longer listing times. However, homeowners with low mortgage rates may not feel pressure to sell quickly because their existing financing is so favorable. Ultimately, the lock-in effect is one of the key reasons today's housing market feels very different from previous downturns. In the past, rising stress often caused more homeowners to sell. Today, many homeowners are financially incentivized to stay exactly where they are. That dynamic is slowing the normal flow of the housing market and creating one of the most unusual real estate environments in recent history. And honestly, if you're trying to decide between renting or buying a home right now, it's important to step back and look at the numbers logically rather than emotionally. Let's say a home is priced at $500,000. With a 20% down payment, today's mortgage rates around 6.5% plus property taxes, insurance, and other housing costs, the monthly payment could easily reach around $3,500 or more on a 30-year mortgage. Now compare that to renting a similar apartment for around $2,500 per month. That's roughly a $1,000 monthly difference, or about $10,000 to $12,000 per year in additional housing costs. Now imagine instead of spending that extra money on a higher mortgage payment, you consistently invested the difference into a broad market index fund tied to the S&P 500. Assuming an average long-term annual return of around 7%, after 10 years, that investment could potentially grow to nearly $150,000. That's a significant amount of money. And it highlights an important point about today's market. Affordability matters. Right now, with elevated home prices and high interest rates, buying a home does not automatically make financial sense for everyone. In some situations, renting and investing the difference may actually provide more flexibility, lower monthly stress, and stronger long-term financial positioning. That doesn't mean buying a home is always a bad decision. Real estate can still be a powerful long-term asset, but in today's environment, the math has changed. During the low-rate COVID era, buying often felt like the obvious financial move because borrowing was so cheap. Today, the cost of financing is much higher, which means buyers need to evaluate homeownership much more carefully than before. The key is understanding that a home is not just a purchase price, it's a monthly cash flow decision. And when interest rates are this high, that monthly cost becomes one of the biggest factors shaping whether buying truly makes sense. If you made it this far, give it a like and subscribe to the channel. Thanks for watching. Disclaimer. This video is for educational purposes only and is not financial advice. Always do your own research before making financial decisions.